Welcome into another episode of The Real Deal with Connaé Pisani. I'm Connaé Pisani, and today we have Derek Thompson joining me from Scopo Mortgage. Derek, thank you so much for being here. You're just a value add to our team. Derek and I often work together with our clients and our agents to help our real estate investor clients acquire new assets. Derek, tell us a little bit about yourself.
Well, first and foremost, Connaé, thank you for having me. It's a pleasure to be here, and I look forward to the discussion. My name is Derek Thompson. I'm the broker owner of Scopo Mortgage. We are a full suite brokerage located in Southfield, Michigan. We've been there since 2020. We help everybody from first-time home buyers, but specifically investors, acquire and build their portfolios across the board. So all things real estate financing, first-time home buyers to investors, but we're here as a resource locally for anybody looking to get into the real estate arena.
Perfect. And you mentioned it right there, relationships. Relationships are everything. Whether you're a new or seasoned investor, I feel like building those relationships is really the core of making it successful, whether it's from a brokerage standpoint, a financing standpoint, finding the right agent or firm to work with. What have you experienced in your career, Derek, just being a broker owner and understanding the unique nuances of each client, how they respond to that personalized relationship building? What do you think is like the most important aspect of that?
Well, I think the really biggest part when, building a partnership between a, client, a lender, a client, a realtor is a lot of the time transparency, right?
Right.
Having, either a plan or being transparent, saying you don't have a plan,
Right.
You need help,
Yeah.
to figure out what needs to be done. So I say communication a lot of the times is really that biggest piece initially between clients, agents, lenders, to where, it's all about feeling comfortable again from a relationship base. These are big investments. These are big decisions that people make. So, having that comfortability, of knowing who you're working with, being able to communicate effectively, to answer questions, get things resolved if need be, it's all very, very important and critical. So I think, more often than not, that first piece of communication and transparency of what's trying to be accomplished, as well as, where you are currently or whatnot, taking that assessment and being transparent with your financer, so that they can help you put you in the best spot. So I think, that's where there's a lot of discrepancy or gray area sometimes with people is, they miss that first initial piece of that building relationship through communication and transparency that then allows the rest of the process to be that much more efficient.
I totally agree. I know when I was acquiring my first investment, that communication couldn't be more important. And it might seem like from a broker perspective, you do this all the time, so you're used to, the process and the paperwork that's involved. But as a first-time investor, I know I was having trouble sleeping at night because I'm signing on the dotted line. It's a big investment. I'm wanting to make sure that my money is going in the right place. Sure, I've located a property, but am I financing it correctly? Am I positioning myself to be able to make this investment work for me?
100%.
And having the right realtor or broker to be working on my behalf is an important piece of that, but also from a mortgage perspective, making sure that I have the right mortgage broker that understands what I'm trying to accomplish and can guide me through that process, not rush me through that process. I think that's really important as well. So I want to ask Derek, how comfortable are you working with new investors versus seasoned investors?
So I'm comfortable with both, honestly. Both of them present their own challenges as well as advantages. Working with seasoned investors is always nice because they're not their first rodeo, right? They kind of know and understand what to expect. They've been in different situations before, so they have things to compare and contrast to. So, a lot of times the more experience you get as an investor, when things are off or when things need to be reconciled, or if somebody is not doing their job in the part of the process or whatnot. So working with seasoned investors is always nice because, again, they're privy to the process, right? They know what's going on. It's not their first rodeo again. Yeah. And, they're a lot more efficient, I'd say, on the front end as well as in process.
Okay.
Now, also working with new investors presents its own, advantages as well too, because I love working with new investors. They're very forward thinking, excited, very teachable a lot of the time, depending on the client. But new investors, the biggest challenge a lot of times is kind of like we're saying is if you don't have that relationship with your lender or your relationship with the realtor, and it's again your first go round, you just don't have a lot of reference points to kind of compare the information that you're getting. So it can be a little bit scary, I'd say. So that's what needs to be done from the lending side on our end as brokers, loan officers, whatever the case may be, is to make sure new investors or new clients, whether it's an investor, home buyer, whatever the case is, are comfortable.
Understood.
Because once they're comfortable and they understand what's going on, then they'll be able to help the lender a lot more as they're navigating the process.
And that makes a lot of sense. One thing that I think you've been a really valuable asset to our team at National Real Estate Management Group is the fact that even though you are the owner of Scopo Mortgage, you're still an integral piece of our puzzle. And in terms of establishing those relationships, building that core team to yield itself for successful investments for our clients, you being involved in that process, involved with the agent, involved with the client, really does allow for it to be like a full cycle process where the client really does feel taken care of on all sides. One thing I would like to ask is how do you feel that your involvement with the realtor helps and lends itself to a successful acquisition?
That's a phenomenal question, honestly. And what I will say is when it comes to real estate financing, it sounds cliche, but teamwork truly makes the dream work.
Yes, it does.
You can't get from A to B without having a team when it comes to real estate. Everybody has their differing duties, their differing action items of what needs to be done in order to get the loan from A to B.
Right.
And a lot of times, kind of like we said earlier, is, new investors, new clients, they don't know sometimes when there are some of those breaks in that chain or that process or whatnot, because they just don't have a lot to reference.
Great value add there. One other thing that I wanted to touch on, Derek, is so from a standpoint of an investor buying your first property, you check the box, you've gotten that one under your belt. You kind of gone through the ebbs and flows of learning those lessons and seeing what works, what didn't work, and then wanting to optimize and continuously improve that process. That lends me to say, how does an investor go from one unit to now starting to build a portfolio? What tools are available from the lending side?
So that's the big word everybody loves on the real estate, scaling, right?
Yep.
Scaling your portfolio.
You got it.
The fun part about, a lot of the products they have out there these days are they've introduced a lot more products on the financing side to assist in, scaling these portfolios.
Nice.
So things like traditional financing where debt to income ratios are in play, or, certain approval standards that are needed when doing conventional financing, whether investment property or not. A lot of these newer products that are really catered towards investors on the investment side, make it a lot more efficient on those fronts. A popular product that, probably a major buzzword acronym out here right now, but it's DSCR. That's the debt service coverage ratio loan.
Perfect.
That's probably the most popular product that most investors use to be able to scale the portfolio because it's very rinse and repeat.
Okay.
It's catered towards investors of getting around a lot of those usual barriers of entry that most people face doing conventional financing, and it allows people to actually scale their portfolios without, again, a lot of those burning hoops you usually need to jump through doing conventional.
Love that you mentioned DSCR. That is definitely the buzzword that I hear all the time. DSCR. What does DSCR mean? How do you use this tool to an investor's advantage? How do you get started with it?
Awesome. So DSCR is an acronym. It stands for Debt Service Coverage Ratio, which is just a fancy way of saying property cash flow.
Okay.
All right. So the major benefit of these DSCR loans versus regular conventional financing is that there's no income requirement.
Okay.
So usually with conventional financing, with buying an investment property, you have your debt to income requirements, right? Where lenders assess your income. They assess your monthly debts per your credit report. And they have to, if they're selling these loans for servicing the Fannie Mae and Freddie Mac, they have to adhere to these guidelines of actually originating mortgages that people can afford, right? Can repay. There are federal guidelines with mortgages, especially after the whole crash in '09.
Yep.
So they put in a lot of guidelines and qualifying factors into place to make sure that people are, getting houses or getting loans that are good loans, for lack of a better term.
Perfect.
Now, DSCR, since it's on the investment property side, so we have to remember a lot of these guidelines are on the conforming side, meaning for primary residences.
Okay.
So one major note to note on DSCR, I get this quite a bit, is you cannot use DSCR for your primary residence.
Okay, great point right there. So what is the major differentiator between how a DSCR loan functions versus a regular conventional loan when you're focusing on primary residence versus approaching an investment property?
Perfect. So with DSCR, it's very popular to most people because when you're purchasing property, whether conventional, non-QM, which is non-qualified mortgages, which is a product in the DSC, that the DSCR is in that arena, you put 20% down when you purchase an investment property, conventional, either way it goes.
Okay.
There are some factors where you can put 15% down if it's a single family, if your credit qualifies.
Okay.
But conservatively speaking, you're going to put 20% down, even using conventional financing with income, credit assessment, the whole 9 yards.
Okay.
DSCR is very popular because, again, they do not require you to show your specific ability to repay an income.
Okay.
And it's the same down payment you would do if you're doing conventional financing.
That 20%?
The 20%.
Okay.
So if it's the same down payment, it mirrors conventional financing.
Okay.
The two, again, major benefits of it are the no income assessment, which is very popular for investors, right? Because a lot of times they're entrepreneurs.
Sure.
They own their own business, or they're paid in certain ways, or real estate is their career, I should say. So DSCR gets around a lot of those income requirements with the same down payment percentage.
Okay.
The other part about DSCR that's very popular is they actually allow you to vest in the entity as well.
Okay, nice.
So it's business purpose financing. What you're doing is you're personally guaranteeing the loan as a member of the entity. However, since the loan and title is in the name of the entity, it does not report to your personal credit, unless you default on the loan. So again, a way to kind of help investors scale their businesses without continuously adding to their debt to income ratio, or, putting them in a worse position when they try to do something on primary, to where they will assess income and DTI as well. So again, DSCR just allows for more flexibility and options for a lot of investors, which is the name of the game in that arena.
Love it. Love it. One other question I have. So with DSCR, tell me now, so investor going from one property to two properties, utilizing a DSCR loan, how do you get from 2 to 3?
Gotcha. So the great part with DSCR, it can be used for both purchase and refinance.
Okay.
So what a lot of people do is that rinse and repeat method, right? So where, they'll purchase a property with the 20% down, have it cash flowing for 6 months, do some minor repairs as they go. After 6 months on title, which is conservative, there are some lenders that go to lower seasoning, but I like to be conservative, when it comes to especially setting up, your portfolio. So usually it's around 6 month seasoning per transaction in order to do another one. So I say that to say what a lot of people are doing are putting the 20% down to purchase the property. Then they're getting that appreciation, that cash flow, that, repair repair value or whatnot. So then 6 months down the line, they're rinse and repeating, they're actually able to refinance that DSCR loan, pull out some more equity, and use that to purchase something new.
Love it. So that's the start of the BRRR method.
That's the start of the BRRR method.
All right.
The start of the BRRR method.
Super helpful, super helpful. All right, Derek. So today we're going to talk about how can you refinance and finance really your portfolio? How do you build that portfolio? We kind of touched on it a little bit in terms of DSCR loans and different ways that you can position yourself as an investor. But let's talk about some of the common pitfalls, things to look out for, things to just be aware of. What are some of the horror stories that you've seen?
So quite a bit, but what I will say, the probably biggest gems I give people, when, again, trying to scale or trying to build these portfolios are, one, have an idea. Again, nobody has a crystal ball, right? Or, nothing is perfect, but we at minimum just need to have a idea of what we're working towards to accomplish.
For sure.
Because when it comes to advising, when it comes to options, kind of like we're saying, products, financing, there's a plethora of options a lot of the time. It's all about what makes the most sense for that specific situation, right?
Sure.
So I think a lot of times, and that's where people, they kind of have that nervous point of, they don't know where to start or who to talk to or who to, how to figure out what they want to do, even so that they can communicate that to somebody.
For sure.
So I think a lot of times is taking the time to kind of, do your own research, kind of assess your own situation a little bit, on what makes sense to you and what doesn't.
Okay.
And then once you have that piece of what you're trying to accomplish when you're working with a professional in, whatever field it is, whether it's real estate, financing, they can then adequately advise on what you need to do.
Advisory services.
Bingo.
Real estate strategy, like
100. It's extremely important. And that leads me to my next point of what I'm getting to as well is when you're working with these investment properties, when you're, crunching numbers, even seasoned investors, but especially new investors, you have to work with a real estate agent.
Yes.
You have to work with a real estate agent.
Yeah.
There's probably not, I think I've only told one person in 5 years, and that's just because they were very, very experienced. You have to work with a real estate agent. When you're coming to a lender to kind of figure out what makes sense and what doesn't, how to structure something.
Yes.
Your lender can help you figure out how to, make the money happen for what you need it to.
Okay.
Your realtor, though, is the one who is getting in the weeds with you, right? They're helping you assess these deals, from purchase price to, the after repair value to when you make repairs to it. If your goal is to sell the property at a certain price or to, refinance and keep it as a hold in your portfolio, you have to know where that back end or after repair number is. It's not the houses that are selling in the neighborhood on the next block over, it's not, what you think is comparable.
Right.
Appraisers, and especially over the last few years, are getting very, very, very in the weeds when it comes to valuing these properties.
Okay.
So the biggest thing, whether you're purchasing a rental as a whole, just cash flow, or you're purchasing a, project to complete a rehab on to flip, you have to work with the real estate agent.
Love that. I think that is like a golden piece of information. A real estate agent is trained to have the client's fiduciary duty at first place, and then with our team at National Real Estate Management Group, we work as a full service agency. So when our agents are working with a client, they're leaning on you for the lending piece of it. They're leaning on our construction department for the estimate piece of it. If there's any repairs or rehab that needs to be done, they're leaning internally with their own knowledge to understand what is that after repair value. Is this investment upside down before you even get started? And that kind of leads me to my next question. Like when you're looking at building a portfolio, you want to buy, refinance, rehab, repeat, BRRR. What does BRRR mean, and what are some of the common pitfalls? How can you make that successful from start to finish?
Gotcha. So BRRR is a very popular method out there. entails buying the property, which
Sure.
is the B, then rehabbing a little bit, refinancing, to be either pull out, the money that you spent to rehab the property or pay off the purchase loan if you're doing a hard money or a rehab product, and then rent it and repeat. So
Okay.
to that point, the end goal is to keep it. The BRRR is for when you're scaling your portfolio and wanting to keep properties as cash flowing hold properties
Sure.
or whatnot, which ends with the tenant. So that's where, even to the point, we just made with working with the agent, if you're going to buy a property and rehab it, right, you're going to need to have an idea of approximately how much that rehab is going to be.
Exactly.
You need to have an idea of, if I do this amount of rehab, what is going to be my after repair value?
Right.
Because that's a major thing I see on appraisals all the time. I can't tell you, appraisers put over rehabbed on appraisals all day long, to where you would have got this same value if you spent, 20 grand less in your rehab, because what you were doing aren't value adds or whatnot. So that's where I just mean that a lot of people make mistakes with just not being firm on their numbers up front. That's the biggest thing when it comes to buying properties, doing work on them and keeping them as holds, and heck, even flipping. But, especially if you're keeping it as a hold, being realistic with your numbers.
Yes.
You got to work with the agent up front. You got to work with the contractor up front, or your contractors. You have to have an idea of where these figures are.
Right. I couldn't agree more. And that also leads me back to that full service approach. What about, I can already see this happening, but if someone buys a property, rehabs it, has not run the numbers to actually understand what it could rent for, they're doing upgrades, they've over-invested into a property, and then the property management piece of it is the afterthought. And you can't rent it for what you thought you could. You're in over your head on the construction side. I mean, how do you navigate through a situation like that?
So having a great broker or loan officer or in real estate, having a great team.
Yes.
The funny thing with real estate, right, is, there are methods, that are successful, right?
Sure. Yeah.
But with real estate, every deal is subjective.
Okay.
There are kind of baseline, situations, but for the most part, every deal is subjective. Every property has different tax amounts, right? Has different insurance amounts, different rehab amounts, different purchase prices, different after repair values.
Yep.
So it's very subjective. It's all about the kind of the piece we're saying is having a team to be able to navigate it. Because that's my key word with financing and real estate mortgages, navigating it.
Okay.
Things are going to come up. It is what it is. You just have to have a viable team that knows how to assist in navigating those things that do come up.
I couldn't agree more. That teamwork, like you said, the teamwork makes the dream work.
100%.
So talk to me a little bit about hard money loans. Like, that's another popular buzzword. It's been in the industry for a long time. Hard money can work to an investor's advantage, but it can also work to their disadvantage if it's not leveraged correctly. Tell me a little bit about what you know about hard money loans.
So hard money, we do quite a bit of hard money as well. Hard money is a lot different than the rental side or the DSCR product.
Okay.
Because there's a lot more moving pieces, right?
Okay.
So what you're doing essentially with hard money loans is you're getting the acquisition loan in order to purchase the property, and they're also keeping as part of the loan a construction holdback.
Okay.
To reimburse you for the work that you're doing on the property until you either sell or refinance.
Okay.
So one thing people need to remember with hard money is they're not long-term loans.
Okay.
These are bridge loans, right? Usually anywhere from 6 months to 12 months to 18. There are some that do 24 for bigger projects, but for the most part, these are interest-only bridge loans.
Okay.
The goal behind them is to reimburse you for the rehab that you're completing until you finish your project, so that you're not essentially bleeding out when you're doing the rehab.
Got it.
Now, I say that to say you still need to have systems in place and understanding, different risk tolerances and risk thresholds, because again, things come up. There are holding costs. There are things that come up with the rehab or whatnot. But the main goal with hard money is to essentially get around that initial piece of financing of a property needing to pass an appraisal.
Okay.
Because that's the big kind of piece with DSCR for those rental properties is since there's no income assessment and they're, qualifying on the cash flow of the property,
Okay.
it needs to be livable.
Got
So
it.
it can't be a down to the studs and rehab when going DSCR.
Got it.
Now, if it won't pass the appraisal, that's when clients look at doing hard money because they can then still get a loan to acquire the property, usually anywhere from 10 to 20% down on the acquisition, and then they'll reimburse you for the rehab that you get approved up front with the lender as well while you're waiting to complete your project.
Got it. Okay. So is it possible to BRRR with hard money?
Yep. So BRRR with hard money is the portion of purchasing and rehabbing.
Okay. So the front end of it.
Yep, the front end of it. So
Okay.
BRRR, a lot of people use hard money and DSCR in tandem, actually.
Okay.
They'll use hard money to purchase a property because it's a, dilapidated property or needs rehab, whatever the case may be. So it won't pass, regular financing or an appraisal.
Okay.
So they'll use hard money with these, 12-month bridge loans in order to acquire the property and rehab it.
Okay.
And then what you're doing then is using the DSCR product to refinance and pay off that bridge loan, turning it into permanent finance.
Got it. Got it. Okay. Do you agree with this philosophy? I was always taught this, and this is definitely how I approach real estate investing, is you make your money on the front end. You don't buy a property with the hope of future appreciation, although we all know as real estate, it's an appreciating asset. But what is your philosophy on buying a property, maybe overbuying on the front end and maybe hoping that it'll appreciate in the future?
Great question as well. I would say very subjective too, kind of as well.
Okay.
On the front end, kind of we've been discussing, you're not incorrect, whereas that's where you see if you have a deal, even a viable deal. That's where working with the agent is important because, you have to have an idea of what you're shooting for.
For sure.
I tell people all the time when it comes to ARV and these, these numbers that you're assessing up front for these rehabs, you should be very conservative.
For sure.
Very conservative. You should not be going to kind of the top of the ARV hoping that that's where it gets to your point.
Yeah.
Because aside from if the ARV is there now, we know how real estate works, right? What the comps are right now might not be what the comps are 6, 7, 8 months from now anyway, or whatnot. So being very conservative with those numbers is important up front to your point so that you're not putting yourself in a position that you can't get out of.
Right.
What I like to say as well too, though, is especially with hard money and rehab on these properties and loans, there's no profit till the back end.
Right.
When it comes to that. A lot of people, a major mistake I see a lot is, they'll have, say for instance, a $50,000 rehab budget, right? Mm-hmm. And they're getting a, certain ARV based on the completion of that rehab budget and allocation of those items. A lot of people, they may get some of the work done a little bit cheaper than what they have on the scope of work, or they may, cut a corner on something with the rehab. It makes a difference. It makes a difference. Just because you can get your contractor to do it a little bit cheaper when you get reimbursed on hard money does not mean you pocket the difference.
Oh, gosh.
That it kills me when people do that because at the end of the day, people have to remember it's a bridge loan interest only. It's not your money yet.
Right.
It's not your money yet. It's a reimbursement on the work that you're supposed to be doing to get to a certain after repair value.
Right.
So major issue I see a lot is a lot of people kind of cut corners on their rehab.
Okay.
So that their ARV doesn't end up being exactly what it would have been if they would have
With the original plan.
Bingo.
Okay, got it.
Bingo. So I tell you all the time, whether you're getting your rehab done cheaper, put it into something else in the property. Nothing matters at the end of the day until you either sell the property to pay off that bridge loan and see your profit, or you refinance to pay off the bridge loan and you have a cash flowing hold. Until then, everything in between is all just part of the process.
Got it. Smart move, smart move. One other thing I was taught, like, I'm just kind of dropping the ABCs of real estate investing, but I was taught that you should leverage other people's money, but at the same time, you don't want to just go all in utilizing so much lending. You do want to have equity in your investment portfolio. What is the right mix?
Again, very situational and subjective to the portfolio and the person. But I personally tell people all the time, again, like we were saying, every deal is subjective. Everything's a little bit different. So I'm more of a fan, honestly, to your point, of leveraging your portfolio to do projects versus hard money.
Okay.
Hard money is, again, you got to do what you got to do, right? We know how real estate goes. If cash flow gets to a certain point, or you need to kind of make your same couple thousand turn through the whole project from reimbursements, then you got to do what you got to do, right, to get it done. But I'm more of a fan of leveraging the equity in other properties in order to do your projects.
Okay.
That way you're not one under the thumb of a lender on those rehabs, because again, they're reimbursed, right? So you got to figure, you have your scope of work approved up front, but you do something a little bit different while you're doing your rehab and it doesn't line up with what the lender had approved up front, you're going to have some issues getting reimbursed for the money that you're then continuously spending for the rehab.
Right. See, and that's exactly where I'm headed with it, because from a construction standpoint, I have a strong construction background. I've seen it happen where, let's say you have your initial scope of work, you get started, you have the hard money loan to get that going, and then the contractor pulls down the walls to only realize that the walls are infested with asbestos. And now your scope of work just went from plan A to like plan Z within a matter of hours.
100%.
How do you navigate through a situation like that?
And that's where working with a seasoned team up front, hopefully accounts for a lot of that. Okay. Now, again, we know how real estate goes. There's not going to be a situation where you can account for everything all the time, right? But to that point, that's where things like, inspections up front, working with agents who, again, they're privy to, investment properties, and they can kind of know some of the ramifications or, pitfalls of it as well too. What I tell people, hard money wise, when you go see a property, you should walk it with your contractor and realtor. Like 100%. You should bring your contractor with you to go see the property, because a lot of things to that point, the contractors, if you have a good team or a good contractor, they can get ahead of a lot of those items and know kind of, hey, this doesn't look exactly right here, so doing this may be a bigger issue than what we, really want to account for or whatnot.
For sure.
Again, most people put themselves in bad spots with real estate investing when they're not in alignment with the project or understanding the different avenues, that it entails, which is, a direct correlation then of the team around them, because your lender should be then, preparing you for different avenues. The realtor should be preparing you for different avenues. Your contractor should have different avenues depending on what needs to be done. So I think a lot of it just always boils back to having that viable team around you to be able to help you navigate.
I couldn't agree more. I still always defer back to like full service. I know when I first got started, I was trying to do it all myself, and I went through the lessons learned and, sometimes stumbled along the way, but I really did resolve to realizing that having a reliable contractor, a reliable broker or agent, a reliable lender, like that really did alleviate a lot of pain points, and really was honestly like the foundation of how I started the company. But I just always defer back to saying, like, the team around you, having reliable feet on the ground, even if you're local. One person can only see so much, but many people can see so many more things working together cohesively as a team, and I don't know, I just go back to that team-based concept. I just think is just so important.
It makes all the difference in the world. It sounds like we're being the dead horse, but I will be honest to you, like, it makes all the difference in the world, down to your, I've had closings that, the insurance agent not being on their game, has delayed things or messed things up, again, the agent, the lender, some, in certain cases. So again, it's not beating a dead horse, but, we want you guys to really understand that having, again, that team and that presence to help you, understand things you don't, is the name of the game.
And it's worth every penny too.
Every penny.
I mean, I know from a lending perspective, like there's certain things that an investor just legally cannot do, but we see it from like a property management, construction perspective, sometimes from a real estate agency perspective where investors are overzealous in wanting to do it themselves. And some are successful in doing that, but I say the level of effort that it takes to really cover all aspects of that, it's so tedious, time consuming, and honestly just overwhelming, you know, to the point where it makes sense to leverage the team to be able to take some of that burden off of you so you can focus on your next deal and build that portfolio.
Yep. And like you said, that's the name of the game, because a lot of times, you know, people, like you said, they, you know, had a cousin who did something or an uncle who did something, or, you know, where again, information is something that we should all take, you know, and be privy to. So I don't want to say don't listen to people, you know, or whatnot, but, you know, it's one of those things as well to where the situation that somebody else went through when it comes to this arena is a lot different as well too. So I see that a lot, you know, to kind of piggyback on the previous few points as well, is a lot of people defer to taking advice from people that aren't in that arena over people that are.
Okay.
And then it kind of puts them in a damage control situation more so than being efficient throughout the process, because everything's a fight, because it's not exactly what one specific process for somebody else was.
Right, exactly.
You know, way back when.
Makes sense. That totally makes sense. I just want to take a few steps back. So like looking at the construction piece of it, we talked about, you know, how to BRRRR, how to build a portfolio, how to leverage hard money if needed. Can you also speak to the tools that are available for just the rehab? Do you also do rehab loans?
Yep. So rehab loans are a thing as well too, especially for already acquired properties. You know, that way they help you, you know, complete your project. What I will say is rehab loans for already owned properties, they're not a lot harder than hard money.
Okay.
They're still in the same hard money arena,
Okay.
just different structure a lot of times. So lender to lender, it'll be more specific lender to lender.
Okay.
There will be, you know, a lot of things at play, such as, you know, what you purchased the property for, you know, what that rehab amount is versus what that, you know, current as is value is.
Okay.
Or whatnot. A lot of lenders aren't, you know, rushing to lend 2, 3, 4, 5 times what the current home is worth even at that point.
Okay. That
you
makes
know,
sense.
so a lot of times when it comes to things like that, they'll want to see, you know, experience, you know, have you ever completed a project before?
Okay.
You know, kind of income's not in place. So credit, you know, usually needs to be a little bit on the higher side, just because those are a lot riskier loans
Okay.
when it comes to financing with lenders, but definitely doable. They work a lot similar to the regular hard money.
Okay.
It's just you're taking out the portion of acquisition.
Got it.
So you're getting your scope of work approved with the lender. They'll approve the scope of work and give you a after repair value based on that scope of work as well too.
Okay.
A lot of times they'll want you to bring some cash to closing, just so that you have some equity in the game with them as well too.
Okay.
You know, they're not usually going to make it cash neutral or advance the rehab funds
Sure.
on these properties, but it still works very similar to a hard money, where they will reimburse you for the rehab on a property that you have already acquired.
Okay.
How they structure it though is going to be, you know, different depending on the deal economics.
Got it. Okay. So is hard money able to function similarly to like a home equity line of credit in that case?
So nope, actually hard money and home equity are a lot different.
Okay. Okay.
So hard money is, again, more so going to be those bridge loans, right? So where, you know, you're getting a 12-month loan or 6-month loan to rehab the property, then it needs to be paid off, or it's, you know, whether that's the sale or the refinance, because they have what's called those balloon payments on hard money. So at the end of your 12-month term, that's what I tell people all the time, hard money, the key to beating hard money is time.
Got it.
You got to get in and out of your project, because again, you got to figure, you know, if you're in a project for 10 months, right, and your payment's $1,000, you've paid 10 grand in interest throughout the year. You know, you paid probably 10, 20 grand to close on the property with that acquisition portion. So you're what, you know, 20, 30 grand in on the property, and your payoff 10 months from now is going to be the exact same it was 10 months prior.
Okay, got it.
So that's where, again, a lot of people don't account for holding costs, things of that nature when they're assessing those numbers. Home equity lines work different than hard money, though, because it's more so home equity lines, I would say, are more comparable to DSCR than they are to hard money per se. Home equity lines are essentially you're getting a line of credit on the property to be able to complete repairs or do whatever needs to be done. Now, home equity lines aren't usually bridge terms. A lot of times they're on a set draw schedule depending on the lender. So it'll be usually a 3 to 5 year draw period to where they'll let you draw, say, for instance, if you have a $75K line, you know, you draw $50K to do what you need to do. You pay it back second year, you know, after you sell the property or whatnot, you can then essentially draw on that line again without having to jump through the hoops of continuously doing refinances.
Got it.
Or whatnot. So it kind of works as a little bit more flexible option, I would say. So. Yeah, flexible option when it comes to doing some financing and repairs. The downfalls of home equity lines a lot of time, though, are versus like a cash out with DSCR, is home equity lines follow conforming guidelines a lot of the time. So they'll want to assess your income, you know, whether you're self-employed or not, tax returns, pay stubs, W-2s, you know, they'll want to make sure you're at a certain credit score. You know, it has to usually be a lot of times second lien. There are a lot of lenders that'll do first lien HELOCs, but a lot of times lenders want it to be in second lien position. So a lot of lenders don't like doing HELOCs on free and clear properties.
Okay, that's good to know.
Which is sometimes a burden for a lot of investors if they're doing stuff cash specifically a lot of the time than just trying to pull that equity out.
Got it.
Tell people as well, it's all about comparing options. That's where we come in as the broker to where, you know, we can set it up and say, compare apples to apples, right? You know, this is what it looks like with the HELOC. You know, this is what it looks like with the cash out, close-ended. This is what it looks like hard money.
Perfect.
And then that way you can kind of determine, or we can work together to determine based on what your goal is, what's the more
like optimal tool.
Optimal product. Yeah.
Okay, that's awesome. Yeah, it's great that you can provide that level of service too, Derek, and just like lay the options out there and allow for an investor to look at it from that standpoint. Because, I mean, oftentimes you hear these buzzwords, right? There's other, you know, syndications that are out there, publications that promote certain products. And it seems like this is a great fit, but then to actually be able to do a comparison side by side, I think that's really helpful.
Oh, it's super important. Like, again, you know, I can talk, you know, just talk all day long. But, you know, a lot of times, especially for newer investors, until you see numbers in black and white, it's hard to make a, you know, determination or an idea. It's, you know, all three options sound good, right? You know, if it's going to get the job done. But in terms of what it really looks like, you know, you have to be able to, you know, put things, you know, on paper, for, again, lack of a better term, so that, you know exactly where you're at with certain things.
No, super helpful. Super helpful. All right, Derek. So another question that I have for you is DSCR is a game changer for real estate investors. What are some of the key things that an investor needs to know for DSCR, how to approach it?
Gotcha. So biggest thing is identifying a property and if it will pass the appraisal or not.
Okay.
You know, the appraisal is the biggest part if you're wasting your time, DSCR or not. So one, you know, having a property in mind, you know, knowing if you're qualified when it comes to credit and the assets needed, you know, to purchase the property, which you'll get with your lender. But once pre-approved, a lot of people don't know, you can DSCR even over 4 units.
Oh, really?
Yep. So you can DSCR. A lot of lenders will go up to 20, if not more units. So DSCR product can be used to purchase things like multifamily apartment buildings, you know, certain type of commercial properties, multifamily, still without that, you know, traditional income assessment and things of that nature. So I think, again, that's a lot of the biggest part as well. Residential and commercial, a lot of the time, DSCR is a viable product as well.
Love that. So what about for things like mixed use, maybe office and residential combined?
Very specific lender to lender. So a lot of lenders, you know, will allow for mixed use with DSCR, some will not. So that's more so the piece of working with a viable broker that kind of knows and can shop around, make sure you're in the best product for your specific situation. Perfect.
Now, what about the down payment for DSCR? Is it 20% across the board no matter what?
So some lenders have moved to 15% for single families, but a lot of those lenders want you to be at a substantially higher loan amount.
Okay.
So, things like, 150 grand loan amount after the 15% down, if it's a single family,
Okay.
sometimes can get swung. What I've seen a lot with lower down payments on DSCR is, they'll hit you for it somewhere else, right? Whether that's increased interest rate pricing or, increased origination, whatever the case is. So a lot of times it still works out to being very comparable to if you're putting 20% down, getting that better, straightforward pricing.
Okay.
Or if you're going the 15% route, getting beat up on pricing a little bit, for lack of a better term. So, but usually I tell people account for 20%.
Okay.
Some lenders will go to lower credit scores with higher down payments as well too. So, 25, 30, 35% can sometimes get you around certain credit, factors or events or, situations. So pretty, situational baseline, though, 20% DSCR is what you're looking at.
Perfect. Okay. And then is there like a limit that you've heard of for DSCR? Like, could you even do like a jumbo loan type of DSCR situation?
So there are lenders that do jumbo DSCR as well too. Very specific lender to lender. So whereas DSCR not being a conforming product that's baseline no matter what lender you go to, it's specific lender to lender because it's what's called a non-qualified mortgage. So it's more of an in-house product with that specific lender. So just very situational lender to lender. But yeah, there are definitely, lenders that offer, up to jumbo loans DSCR wise as well.
Okay, perfect. Okay, so just taking into consideration like this buzzword DSCR, to me it's a buzzword because I hear it a lot from our clients. But is this something that's new? Why has it become so popular lately?
I think just the information being more readily available, is really pushing it forward a lot. People are seeing people in their communities, local people, utilizing the product and having success with it. It is not a new product by any means. They've had DSCR around for years now, but it's one of those things to where, again, with things like the economy and income with people, right? Credit, overall for the nation, DSCR, has gotten more popularity the last few years with allowing to get around some of those barriers of entry, that people traditionally face.
For your business, what would you say is the percentage of real estate investors that you've seen like within the Metro Detroit area versus like primary residence type of transactions?
So I think that that's a great question. So I think there are still a very, very, very high. Now, again, I'm not on MLS or Realtor. I don't know the exact numbers. I won't lie to you. But from what I see and just with dealing with my agents, my clients, the industry, what's out there, there's still a lot of home buyers in the market or whatnot, because you got to think about it. Investors and home buyers go hand in hand, right? These investors are buying these properties, rehabbing these properties, using these products we're saying to be able to sell them to these first-time buyers or whatnot. So, that's something to consider as an investor is, like we're saying, everything is about your sale or your refi, the back end. So, what does the market look like? Is this going to be even if the comps are there, are buyers going to be able to afford this type of property? A lot of people get into trouble going to higher end rehabs, in those 200,000, 300,000, 400,000 because your buy box a lot of time for that is a lot smaller than it is, 200K or less. So, investors a lot of times need to determine, what kind of buy box they're looking in, which all circling back to working with your realtor of knowing what the market looks like. What can you sell this for? What's going to be easy to sell? What's going to be hard to sell? What's a project? What's a quick flip? What these numbers are. Just all circles back to being, on the same page and aligned with who you're working with so that everybody can work together to accomplish the goal.
Love it. Love it. We haven't seen a slowdown. In fact, in Metro Detroit, I feel like we're still seeing a surge and influx of real estate investment and just home buying in general. Definitely market specific, but Does that also speak to what you're seeing on the lending side as well?
Oh, 100%.
Okay.
Especially from an out-of-state standpoint. I'd say the last probably few years, there are more out-of-state investors that are, jumping at the bits or, cannot get enough of Detroit right now. Because again, like we're saying, our values are a little bit still lower right now on the front end, but we're very volatile when it comes to those ARVs right now. So you're able to get a lot of more substantial spreads here when you're buying and rehabbing real estate than you are in other states.
Okay.
A lot of the time, just even from that initial, acquisition standpoint or value standpoint. So, no, I would say, right, yeah, investors are, still moving and grooving in Detroit. There's been a lot more local investors now, I would say, over the last few years, because a lot of people are, seeing these people, rush from other states to purchase here and buying up everything. So a lot of, local people who understand the market, who understand how to do things, have now kind of really taken that leap full-fledged into the deep end of, getting into the game or, planting their flag, when it comes to real estate investing here. So, I would say definitely still on the up and up.
I would agree. It's funny you mentioned that, because it's kind of one of those things where when you start to see out-of-state or out-of-country investors investing in your own backyard, it's like, what am I missing out on,
I'll tell you what's funny. I had a couple years ago, I had a few clients from California that just bought up, they were buying 3-4, properties a month or whatnot.
Nice.
And they bought one, in my neighborhood. I'm like, what? I went and got, I had to get one a couple months later. I'm like, I see the writing on the wall.
It's go time.
It's go time. But to that point, being aware of what's happening around you a lot of times is that missing piece that a lot of people don't really, realize and understand, being sometimes the fly on the wall of seeing, how things are operating and moving, so that you can, implement that into your strategy. A lot it goes unnoticed a lot of times.
I had an investor client ask me, what is the right time? Interest rates are still, relatively high compared to where they were, let's just say like 5-10 years ago. Is now the right time to buy? And if it is, or if it is not, when is the right time to jump in, maybe refinance? What's your answer to a question like that?
This is the cliche thing I hear from realtors. The right time is for you, right? but no, honestly, now is still a very, very good time in Detroit. We are still, even though values are, on the up and up, and, things are volatile and fluctuating, still with talking with, most of the, regional investors, out-of-state investors that are still doing a lot here, it is still a lot lower or easier to get into the market here than other places.
I agree.
So, to that point, I think we still just have so much potential of being able to be on the front end of a lot of these, swings, value-wise, neighborhood-wise, to where, I think it's still about as good a time as you could possibly, right now, because things aren't going down.
Right.
So,
And inventory is still relatively limited. And in terms of like interest rates, I just think that if you have the opportunity now, why not go for it? And you can always refinance later, right?
100%. Most of the savvy investors right now are, purchasing higher interest, lower cost right now, keeping more liquid cash in pocket if possible, taking a little bit higher interest rate, lower cost. And then to your point, when appreciation comes around, when interest drops, when, they've gotten a substantial, value add from rehab they've done, that's where you really, really, really see those wins when you refinance.
So how are you staffing up for that?
Anybody want a job? No. But to that point, one big thing we've been doing is, I've been wanting to really push a lot more people getting into lending. A lot of people are agents, a lot of people contractors, insurance. There aren't a lot of lenders,
right.
Or a lot of good lenders, sure. I should say. So, that is something we've actually been thinking about, is, kind of doing like a loan officer university type of thing,
I like that.
to be able to help people get from A to B and then transition right into a producing role.
Nice. And to piggyback off of that, like on our side, we're not seeing any slowdown on, you know, real estate investment specialized agents joining our team. Now is the time, you know, just preparing for what's headed down the road. I don't see any slowdown happening anytime soon. So it's an exciting time to be in real estate.
Yeah, nope. It's one of those, you know, you want to get on the right side while you can.
Yes, yes. Derek, it's been a pleasure speaking with you. Thank you
Likewise.
so much for joining me.
Likewise, I appreciate you having me. You've been
Thank
phenomenal.
you.
It's been awesome.
Thank you so much.
Of course.
All right.